A few days ago, the Japanese yen crashed past the psychologically important line of 150 yen to the dollar. This had been considered an unbreachable line by the Bank of Japan, their version of the Fed, but apparently they failed. This is giving rise to warnings that Japan could spark the next global financial crisis. So what's happening in Japan? In short, their zombie economy, fortified by extravagant levels of public spending at zero interest rates, means that investors can currently make roughly 4 to 6 times more investing in the US or Europe than in Japan. This is sucking trillions out of Japan, which means selling metric tons of yen for foreign currencies. So there's too many yen, meaning cheap yen. So far, this giant sucking sound has dropped the yen 20% against the euro, while it's lost almost a third against the US dollars since 2021. In fact, the yen is now the weakest since the bubble economy burst way back in the late 80s when Bryan Adams was topping the charts. This is all a problem because it raises prices for Japan's imports, most notably energy, of which Japan imports nearly 100%, and food, where Japan imports roughly 2/3 of what it eats. In US dollar terms, all of those are now 50% more expensive than before the fall of the yen. Toss in industrial imports from ores and metals to machinery, which make everything more expensive for Japanese consumers. Now, Japanese household income has been flat for 25 years, so a 50% hike in prices is pretty rough. The problem is the solution to a weak yen is to raise interest rates to erode that 4 to 6 times gap. But the Bank of Japan cannot raise rates, partly because the Japanese economy is too weak, but mostly because Japan has built a turbocharged version of the debt trap that Washington is busy building for the rest of us. Public debt in Japan is currently 267% of GDP, which would translate into roughly 60 trillion in US terms. To illustrate the problem, at the current target of 1% yield, roughly 1/4 of Japan's government budget goes to debt service. But if the Bank of Japan raised rates to US levels, so that would be about 5% on the long bond, debt service would become 125% of government spending. Of course, the rest of government still needs money, from defense to highways, so call it a clean doubling. Now, Japan already takes 1/3 of GDP in tax, and the top rate is 45%, so doubling tax revenue is impossible. You would be close to Soviet levels of government dominance. So what's next? Brought to you by Unchained. What's next is Japan's slow-motion train wreck may be about to get a lot faster because inflation is finally rising. This is pushing both the government and the Bank of Japan to pump out yet more money. This could become a cycle where they pump out fresh money to defend rates and defend the yen, but that fresh money itself raises rates and crashes the yen because of future expectations on inflation. This market-driven rise in rates is already starting to happen here in the US, and we're at half of Japan's debt level. Japan has built itself a leviathan of debt big enough that it could spark the global debt reckoning. On the bright side, it could warn Washington off the suicidal path it's currently taking. On the dark side, it will be brutal on the Japanese people and could spread sovereign debt contagion that makes 2008 look like a cakewalk. Yesterday's newsletter talked about this very thing. Check it out at petersadange.com. Okay, we'll be watching. See you next time.